funds, same fund house, both open on the 10th of July, opposite strategies. One buys the stocks that are already winning, the other buys the ones the market has thrown away. So, which one is built for you and which one quietly hurts if you buy it for the wrong reason? To answer that, I'm joined by Nirmay Choksi. He's Executive Director, Research at NJ Asset Management. Nirmay, welcome to this conversation.
Thank you, Ruchira, for having me over here.
Now we'll take them one at a time, momentum fund first and then the value fund. So when it comes to momentum, the idea is simple. Stocks that have been winning tend to keep winning for a while, but this fund, it makes a decision before anything else. And that is where I want to start. It checks for quality first and then momentum. So you've thrown stocks out before you've even measured them for momentum. What are you giving up by filtering for quality first?
In terms of our style of managing money, we follow what is known as rule-based investing or also known as factor investing. So
Yeah.
commonly there are the four main factors: quality, value, momentum, and low volatility. That as a fund house, the philosophy that we have is that we want to focus on quality. What we imply by that is that none of our funds will ever invest in a stock that is of subpar quality. What we mean by subpar quality, according to us, a stock that has made losses in 3 or more years out of the last 5 years, that is burning cash, that has not paid any dividends, that has high levels of debt, or that has a lot of issues related to their promoters or governance and other forensic issues, or is a highly volatile punter stock. Now, why we want to do that is because we believe that these kind of companies are eroders of wealth over a long period of time. In general, if we talk about a raw momentum strategy or a momentum factor fund, how it would work is that it'll start from the universe, let's say Nifty 500, and then select stocks primarily based on momentum, say 6 months momentum, 9 months momentum, 12 months momentum, without looking at any other filter or factor such as quality. Now, why we are instead of that applying a quality filter first is because the universe of Nifty 500 has all the good quality companies, which we call as gems, and the bad quality companies, which we call as stones as well. And if we apply a raw momentum approach, then momentum does not care about the quality of a stock, right? It does not care whether a company is a Rajesh Exports or an HDFC Bank or an ITC, right? As a fund house, we don't want to invest in bad quality momentum stocks, even if they tend to be multi-baggers, because it shows that in the long run, they do not add much to the portfolio's returns, but at the same time, they in fact drag down the overall portfolio's return and add to the volatility and downside. To give you an example, like we did an analysis on a stock of Jet Airways. So the stock of Jet Airways from about 2009 to 2010, if you looked at its 12 months return, and it gave a return of about 150%. But if you look at the return 12 months from 2010, and you will see it eroded more than 71% of investors' wealth. And why that happened? Because since 2008, Jet Airways was in a lot of financial trouble, right? Its ROEs or its profitability were in the negative. It was bleeding. It had very high levels of leverage, which were increasing year over year. And it was into serious liquidity issues as well. But still, the market, for some reason, from 2009 to 10, ignored that and the stock rallied. So that is the problem with a raw momentum strategy. And that is precisely to address that we are following this filtered momentum approach where quality will be first and only stocks that will pass the certain basic quality filters will be screened for momentum.
Right. Now, quarterly rebalancing is what keeps the fund in the winners, but momentum, it turns fast at the top. So, in a crash, does that same principle of buying what has been rising and selling what has been falling, does that become a source of additional damage?
Yeah, definitely. See, momentum by its nature is a factor that is of a very aggressive nature, high risk, high return kind of a factor. And it is a factor that has very high beta. What I mean by that is that its returns are amplified both in the bull markets and in the bear markets. So if the market goes up by, let's say, 15-20%, you can expect a momentum based strategy to deliver much higher returns in a bullish phase or in an expansionary phase. But as you rightly pointed out, a momentum based strategy or momentum factor in general will tend to fall much more than the market, specifically in the short term, whenever there are such sudden market crashes or corrections. So that is the nature of the product, and that is what gives that premium as well. Today, if you look at the long term data, the momentum factor has delivered about 21% CAGR over the last 2 decades in the Indian market. And the reason for that exceptional outperformance is because of that risk premium. Having said that, momentum is not something that is a fad or a theme. Themes are like fads, they come and go. But momentum is an empirically proven factor. It has been financially proven over research of more than 15, 20, 30 plus years of data. And there are multiple reasons that show that this momentum effect is not an anomaly, and it is actually a risk premium, be it quarterly rebalancing or half yearly rebalancing. Momentum is definitely something which people need to be cognizant of, that during bearish market phases, during correction phases, the strategy may underperform. That is the nature of it.
Right. So, like you mentioned, 21% returns for the last 2 decades. Let us now talk about the cold phase, because, momentum index, it returned under 5% over the 5 years to March 2020. And today, the same number is over 16%. So, same strategy, but very different decades. So,
Right.
what does living through that cold stretch feel like? And how long can it last before the factor actually pays back?
Right. So, to answer that question, I would like to talk about what is known as factor cyclicality.
Hmm.
What factor cyclicality says in simple terms is that just like different sectors, right, we don't expect IT and pharma and FMCG and oil and gas and auto to all outperform and underperform at the same time, because the sectors have their own characteristics, they have their own cycles. Similarly, these four factors that we talked about, quality, value, momentum, and low volatility, each one of them have their own cycles. As we discussed about momentum, momentum is a factor that does well in a expansionary market. In a bearish environment or a environment of economic market turmoil or slowdown, momentum will not outperform. It will in fact be one of the worst performing factors. Similarly, let's say in a period of market correction or slowdown, low volatility and quality will be the factors that will tend to be the winners. And in a period of sharp market recovery post a fall, value as a factor will tend to be one of the best performing factors. And that is the reason what you talked about from 31st March 2015 to 31st March 2020, momentum delivered about 5% CAGR over a 5 year period. But the most important point is that in that specific phase from 2015 to 2020, momentum actually was, I think, the best performing factor, while the return across all the factors was a single digit number. But if you look at the market, because it was a period of COVID bottom, and most importantly, that was a period when value factor delivered negative 6.65% CAGR for a 5 year period. What that means is that an investor who had invested a lakh rupees in the value factor, let's say in 2015, would have lost 30% of his capital even after waiting for 5 years till 2020. And his capital of 1 lakh would be worth about 70,000 rupees. And if we go to 2026, as you said, from 31st March 21 to 31st March 26, just 6 years forward, and momentum delivered about 16-17% return, and value, the worst performing factor, delivering a negative CAGR of about 6.65%, delivered about 28.45% CAGR for the last 5 year period. And now coming back to what I mentioned before a few minutes. So what do we do to diversify across sectors? Or to reduce that risk, we diversify across sectors. And similarly, we diversify across, large caps, mid caps, small caps. Just having one or two multi-cap funds in your portfolio or flexi caps People think that that is right diversification, but that is not the right diversification, right? Similarly, to address this problem, address these cold phases of momentum or any other factor for that matter, we need to diversify across the factors. Say, for instance, you need a quality factor fund in your portfolio, you need a momentum factor fund in your portfolio, you also need a value factor fund in your portfolio. Because when quality will do well, maybe momentum may not do well and value may not do well. And momentum will do well, your quality and value may not do well. And when value will outperform everything else, then the other factors may not do well. So the gist is that we need a well diversified, factor diversified portfolio which gives exposure to all the different factors, and that is the right diversification.
Nirmay, the thing is that a rule only matters when it is painful to follow. So when your model says hold and the market it's screaming sell, what stops someone at NJ from stepping in and overriding the model?
So we have a very disciplined process. We have a team of about 15 people in research and investment management who follow thorough process, data oriented way of managing money. We have
Mhm.
created our own proprietary in-house research platform called the NJ Smart Beta platform, which hosts data of all Nifty 500 companies right from 1995 to 1275 plus unique companies, 25 to 30 plus years data we have in this platform, and we use that as our backtest engine. Till date, the team has backtested more than 30,000 different strategies. And then we test all these strategies, the ideas or the model portfolios as we call it. And the best ideas are pitched to the investment committee and the chairman of the investment committee, Mr. Nirmay Choksi, who is also the co-founder of the NJ group of companies. Along with him, the CEO is also a part of the investment committee. Execute as per the rules only without deviating from that, without letting our human biases and emotions kick in. Because that is the fundamental reason why we've got into rule based investing. And just to further add to that, from September 23 till September 24, our FlexiCap fund was the best performing fund among the best performing fund among the FlexiCap peers. And in that period also, we stuck to the same rules. And after that, when the fund underperformed, through a down cycle, even in that period, without deviating from the rules, we remained committed to those rules and we still follow those same rules.
Right. Now that covers momentum. Now to the other side of the temperament spectrum, let's talk about NJ Value Fund. Same quality filter, opposite instinct, where momentum buys what is already winning, value buys what the market has given up on. And that raises a problem momentum does not have. Momentum has a clean exit. When a stock loses momentum, the rules drop it at the next rebalance. But a cheap stock that can stay cheap for years, and cheap never tells you when you're simply wrong. So, what is the exit logic here in the value fund? When does this fund decide to, decide that a pick is not undervalued, it is just broken, and let it go?
Any stock that is trading at a low multiple does not mean it is a genuine value stock. It could be a value trap. And that is why, first of all, we apply the quality filter to ensure that we don't invest in a value trap kind of a company that on surface may be looking very attractive compared to its peers, or may also be looking very attractive compared to its historic valuations. But there could be multiple reasons for the market to have reduced or re-rated its valuation. So one such example is of Reliance Power. The Reliance Power share was trading at a absolute P of about 11 and a half. So on an absolute terms, it had a P which was very cheap compared to the power sector companies. Also, the P was very cheap. And also compared to its past 1 year historical P, it was trading at a very relative discount in about August 2017. So had someone ignored everything else and just looked at that, then Reliance Power share would have seemed extremely cheap and undervalued, a good opportunity. But if you look at 1 year down the line, 2 year down the line, or 3 years down the line, about August 2020 as well, then an investor who would have invested in Reliance Power in 2017 would have lost more than 90% of his or her capital. And the primary reason for that was that that was not a genuine value stock. So what is it was a chunk quality and value trap. Now, when it comes to how we buy and sell stocks in our portfolio, first of all, we apply this quality filter. So it helps us avoid such accidents similar to the Reliance Power accident. Then, furthermore, from the stocks that have a decent level of quality, we have created our own proprietary value scoring framework where we categorize each and every company into different business groups. Now, that categorization is done based on their business model. So, whether it is a cyclical company, a non cyclical company, what is the source of income of that stock, whether the company is making money from manufacturing or from services. Then, accordingly, we have created about 8 to 9 different business groups. And then we have defined what are the logical relative valuation parameters that should be looked upon for a stock in that specific business group. Say, for example, a cement company that is deeply cyclical and capital intensive, looking at a normal PE ratio may not make much sense, right? But if I look at a cyclically adjusted multiple, or if I look at a multiple that takes into account the leverage, such as say EV to EBITDA, and that will do justice. And now, how we'll enter stocks? So we'll enter stocks based on the which stocks are relatively attractive or relatively trading at a discount compared to their peers in the respective business groups. And similarly, when a stock's valuation will go up based on their respective value parameters in that business group compared to their peers, then we will exit from those stocks. So we have entry and exit thresholds for both.
Now, value starts from a paradox. You buy what the market has already written off. So, a human investor at least claims judgment. What gives a fixed set of rules the right to disagree with the market across 75 stocks?
We know that just by looking cross sectionally at a P ratio across all stocks, let's say the 500 or 400 companies in my universe, and blindly selecting 75 companies that are cheapest based on P doesn't make sense. Or say, for that matter, even price to book or price to sales or even dividend yield. We understand that a IT stock cannot be compared with a pharma company or a cement company. That is why you need to first of all categorize the different companies into different business groups based on their fundamental business models. And furthermore, recently only we published a special supplement with value research itself on the value factor, which says the factor edge. And there we have also mentioned about this value scoring framework and how that value scoring framework is much more superior than a cross sectional selection of stocks, primarily based on a value indicator such as a PE ratio. So, not just in long term returns, but also in terms of protecting the downside of the portfolio. So, both on a risk adjusted return basis, such a framework can help a lot, and that has been tested through more than 15-20 years of data.
Nirmay, your back test shows the fund returned about 16.2% a year, and
Yeah,
passive index, it returned 16.58%. So the
that's right.
cheaper option came out marginally ahead. What are the investors actually paying active fees for then?
The return that you're quoting over here is the point to point return of the NJ value fund after an expense ratio of 2.5% vis-a-vis the Nifty 500 value 50 TRI index. And that is the point to point return from 31st December 2006 to 30th April 2026. So about 19 years and 4 months worth of history. And the reason why still on a point to point basis, our scheme seems to have underperformed the value index by, let's say, about 38 basis points is because in the last 2 3 calendar years, specifically in the calendar year 2021, 2022, and 2025, a lot of these chunk quality value companies or highly cyclical value companies, which we don't invest in our portfolio because of the quality filter that we talked about, they outperformed the overall market a lot. However, if you look at the rolling returns, which is a much better uh, gauge of the outperformance or underperformance of any strategy or of any fund, then over a 5 year lump sum rolling return basis over 5-year rolling return periods in terms of lump sum investments, our value fund has delivered about 16.35% median return compared to the Nifty 500 value index, which has delivered only 12.39%. Even over 10-year rolling periods, if you see, our value fund has delivered 16.64% median return compared to 14.53% median return for the value index. And more importantly, over 5-year rolling return periods, this fund has outperformed the value index close to 72% of the times, more than 72% of the times, and it has outperformed for a 10-year period close to 78% of the time. It gets tilted heavily towards mid and small cap companies and a lot of cyclical companies as well. That is why if you look at the volatility of the Nifty 500 Value 50 index, and the volatility is much higher than that of the market, Nifty 500 as well. The volatility of Nifty 500 Value Index is 25.55% annualized compared to about 20% for the Nifty 500 index. But now if you compare that with the volatility of NJ Value Fund, and that is just around 18.36%. That is because of the quality forensic governance and the volatility filters that we've applied in our value fund. Also, if we look at the probability of loss of capital over a 3-year period, then the market has a probability of loss of about 4%. The Nifty 500 value index has a probability of loss close to 18% over a 3-year period. But in our value fund, our probability is also close to 4% at par with the market. So it is not just the returns. On a rolling return basis, we are much superior, and more importantly, on the downside as well, the fund has delivered much better on a risk adjusted basis. And bear with me, this is post and expense ratio of 2.5%. The index returns that we are seeing does not have any expense ratio. So if someone were to replicate those returns to an ETF or an index fund, they would also bear the expense ratio and tracking error of that fund.
The timing actually of this launch is striking because value has just had a tremendous run. The value factor, it returned over 28% a year over the last 5 years.
Yes.
One of its best stretches ever. So,
yes.
And as you mentioned, factors are cyclical. So what does buying value right after its best years actually look like?
Right. See, so I wouldn't want to go too much into the timing, while I agree completely that right now value has had a very good stretch. What we discussed about 28.45% compounded over 5 years is extreme. And that too, when you compare values overall long-term 5-year median rolling return of about 14.28%. So having said that, yes, it has been a period of exuberance for the factor. But still, if you look at the value factor's valuation, compared to its history, and it is not in an overvalued position, it is in a fairly valued state only. And more importantly, why right now we are launching these two factors is not based on the timing, because we don't know that what kind of market cycle is going to come 3 years, 5 years down the line from here, right? Rather, what we encourage our investors and educate our investors to do is to diversify across factors, as we discussed. So we have our existing quality factor funds, the NJ FlexiCap Fund, Momentum Fund, the Balanced Advantage Fund, and the ELSS Tax Saver Scheme. And now we are launching the NJ Momentum Fund and NJ Value Fund simultaneously, keeping in mind that these three funds, these three factors per se, have a very low correlation with each other, meaning that when value outperforms, the others underperform. So what we recommend is that rather than trying to time whether value is gonna be the winner from here, continue its rally, or whether it is gonna underperform, or whether momentum is gonna be the winner now, or whether quality is gonna bounce back, the best idea for an investor is to diversify his or her portfolio's exposure across these funds.
Now, one last question. If you could explain what kind of investor should not invest in both these funds, momentum as well as value?
The factors, they are going to deliver returns over long periods of time, at least 5-7 years plus. That is the proven cycle. A factor's premium is going to come, be it momentum, be it value, low volatility, or quality. each factor has outperformed the market in the long run. But if you as an investor are not aligned with the factor, then your return is not going to be as per the factor. So, in terms of momentum, nobody should invest in momentum primarily by looking at the handsome double digit returns that the factor tends to generate over a long term. It is because if you as an investor have a short or a medium term holding period, then first of all, momentum is not recommended at all. 5 to 7 years is a bare minimum for that. But more importantly, even with a long holding period, if you as an investor are someone who would get jittery or anxious during market corrections, and if the market falls by, let's say, 10-15%, and if your fund falls by, let's say, 20-30% in such a period, and you start panicking, to call your distributor or your advisor and tell him or her that I want to stop my SIPs, I want to redeem my funds, I want to book my paper losses and realize them, then this is not a right strategy for you. So only and only if you're clear and have that high risk appetite, if you can stomach those kind of high drawdowns and short term volatility, then you should invest in momentum. That is for the momentum factor. For the value factor, again, as an investor, if you are not patient enough, that a stock that is undervalued today may take a lot of time for the market to realize its true potential, true value. And that may take a long term time. And for stretches, let's say of medium term to short term, the fund may underperform, the factor may underperform. Even the 5 year period that we talked about from March 2015 to March 2020, the value factor indeed delivered a negative 6.65% CAGR. But if an investor is not aware of that, and if he or she were to exit at that point of time, then he or she would never have benefited from the 28.45% CAGR in the last 5 year period. So that is also very important, that you need to be contrarian by nature, and you need to have enough patience for that contrarian philosophy or that undervaluation to revert to the actual valuation.
Well, Nirmay, thank you for your time and taking the hard questions head on.
Thank you so much. It was my pleasure.
The NJ Momentum Fund and NJ Value Fund are both open from 10th of July to 24th of July. If you're weighing either one, do read the scheme documents carefully and talk to your advisor before you decide. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.